It's my great pleasure to have a friend and a colleague and distinguished scholar in this specific topic in particular. Tonight, Professor Ulrich Volz from the SOAS University of London Economics Department. Uli is also founding director of the SOAS Center for Sustainable Finance, which has been very active exactly in looking at issues that we will be discussed today in this topic. Professor Volz has been involved in a number of important international initiatives organized by multilateral organizations, including UNEP, and has been also advising a number of development banks and central banks, including the Asian Development Bank. His publication, we have a link to his long list of publication. Just mentioned recent handbooks on the Routledge Handbook on Banking and Finance in Asia, as much as the report commissioned by the UN Environment on Climate Change and the Cost of Capital in Developing Countries, which I'm sure will topics that will be discussed throughout this night. So I invite you everyone to look at the links in the material that we provided. We are particularly pleased to have Uli tonight. Uli, without further ado, the floor is yours, and we will be discussing in the second part of the event.
Thank you so much, Antonio, for the kind introduction, and indeed for having me. It's really a great pleasure to speak in this seminar series. And let me first try to get my presentation up and running. That's always the biggest challenge. Okay, so I hope I've managed that one. So what I will do is try to give you a bit of a flavor of some of the work I've done on the nexus between climate change and the cost of capital, and why this has become ever more important in the current context, where we have a debt crisis looming in the global south. Here's my outline. After a brief introduction, I will talk about the connections between climate change, climate vulnerability, and sovereign risk, and how this is driving up the cost of capital, and how this is really threatening development progress in many countries in the global south. Then I'll give a brief overview of what the current debt situation is in the global south, and it doesn't look very good. And then I will propose, or kind of present a proposal that I've developed with a number of colleagues over the last 2 years, where we're trying to tackle the debt crisis and link it to action that will help sustainable development and also help build countries that are participating in that to strengthen resilience against climate change and environmental change more broadly. This is something that's gained a little bit of traction, and I'm very much looking forward then to discuss this with the audience, and of course also hear Katie's thoughts on that. So let me start it. The global economic picture doesn't really look that great. So everyone's been hoping for a kind of quick recovery from the COVID crisis, but while in some parts of the advanced world things look fairly okay, not really that great, but kind of okay, the economic prospects in many countries, many developing emerging countries, are rather bleak, and institutions like the IMF and World Bank are constantly warning about diverging recoveries. So also, of course, related to inequality in vaccine access. But an important point is also that the crisis responses we've seen over the last 2 years have been much bolder, of course, in advanced countries. So advanced countries had very expansionary fiscal responses, very expansionary monetary responses, and that has really helped our economies in the UK, in Europe, US, Japan, to muddle through relatively well. And unfortunately, many developing countries did not have this luxury. And of course, there are also big differences between various developing and emerging economies. but the fiscal response has been much smaller, and high levels of public debt service have been a big issue. We've already seen debt levels rising in the global south in the decade prior to the COVID crisis. So already before the COVID crisis broke, IMF and World Bank were ringing the alarm bells that a lot of developing countries had unsustainable levels of debt. But of course, the COVID crisis has worsened this situation. And what I want to emphasize is that debt sustainability is also threatened by climate risks and also other environmental risks. And so this has also been undermining debt sustainability. And the problem is now that we have a very toxic situation where we have high levels of debt, which is impeding adequate crisis responses. So that's a problem, but it's also a big problem because many of these countries don't have the opportunity really to invest in climate resilience and adaptation, which is also absolutely crucial. And so many countries are basically facing severe debt struggles, and countries that are bankrupt will not be able to invest in sustainable recoveries and B in any of the other things they should have been investing in now. So I'll kind of go through this narrative, and then I'll put forward some ideas on how to tackle this. So first, on the nexus between climate change, sovereign risk, and the cost of capital. So first of all, let me emphasize that, of course, all countries, rich and poor, will have effects from climate change, but the impacts tend to be disproportionately large in many countries in the global south because of geographical conditions, but also very importantly because of limited adaptation capabilities. Yeah, I mean, a country like Singapore is also in a kind of very exposed area, but Singapore has a lot of money to invest in resilience. Holland is under the sea level, but they have all the expertise and all the money they need to shield themselves. And of course, the economies, or many economies of developing and emerging markets, are also very heavily dependent on agricultural, fishery services, and so on. And there's of course also a very strong nexus between climate change and biodiversity risk. And many of these countries are also facing very large transition risks, so having very commodity dependent economies and so on. So there are a lot of different risks related to climate change, and this is also creating macro financial vulnerabilities and ameliorating sovereign risk. And so I'll go through a number of, very briefly only, studies we've done where we've shown that both governments and corporations in climate vulnerable countries are particularly exposed to climate vulnerability and are facing risk premia on their debt. And this might sound very technical, but the implication is that a higher cost of debt is making investments, any kind of investment, much more expensive. And it limits the ability of countries and also corporations to invest in adaptation and resilience. And this is ultimately undermining development prospects. And at the same time, it's worsening the debt sustainability situation. And if this is not addressed, this is going to be a very slippery slope, and we're going to see some vicious circles, basically. So I've worked quite a bit on the different ways how climate change can translate into sovereign risk. I'm not going to go through that in detail, but just kind of to give you some of the key points. So we have, of course, physical impacts and transition impacts of climate change, so kind of related to policies, market developments, change in consumer preferences, and so on. And through different ways, they can have an impact on public finances and ultimately sovereign risk. And sovereign risk, in turn, has big implications for the cost of capital of governments, which in turn has a big impact on the cost of capital of corporations. And so we did a report in 2020 on climate change and sovereign risk, where we identified 8 different transmission channels. The first one is depletion of natural capital and natural services. And our entire economies are dependent on natural capital and eco-services. And climate change and biodiversity is very much related, and so greater global warming will also worsen nature risk. There's a very obvious channel through the fiscal impacts of climate-related disasters. So, you have a typhoon blowing over your country, and then large shares of GDP are destroyed. And in one way or another, the public will have to support the economy, bail out the economy, and so on. So this can drive up debt massively, and we have many, especially small island development states, where repeatedly large storms have basically wreaked havoc not only on the countries, but also on public finances. Then the third channel is about the cost of adaptation and mitigation. So there is a huge need, especially in adaptation in developing countries, but of course also mitigation, depending on where you are. And this is also very costly. And so investing in climate action, even though it generates high returns, but this can also be undermining short-term public finances. Then there are a lot of different potential impacts of climate change on the macro economy. Climate change can cause both physical and transitional impacts, can cause supply and demand shocks. If the economy has to go and undergo a transition away from, say, fossil fuel sectors, people will lose their jobs. There has to be investment in new areas of the economy and so on. So there are potentially also a lot of direct impacts on through employment and output and tax revenue and fiscal spending on sovereign risk. And then one area that I've worked on a lot for the last decade is the risks that climate change poses for the financial system. And this can also translate into sovereign risk. So if we have a kind of systemic crisis in the financial system because of what's nowadays referred to as green swan events, then we have then the government may be affected. So we can have these kind of doom loops where banks go under and the government has to kind of rescue the financial system, and then this worsens the standing of the sovereign, and then you have this vicious doom loop, as we saw, for example, during the Euro crisis. Then one area that is very much underappreciated are the impacts of climate change on international trade and capital flows. So that also can have big impacts. And I'm working with some colleagues right now on a paper on the effects of decarbonization of the world economy on trade and financial flows. And these are, for some countries, massive. And so if half your export sector is breaking away, then this will surely have an impact on public finances. And last but not least, there are potentially significant impacts in some countries on political stability. So there's a rich political science literature that shows that climate change can intensify existing intrastate but also interstate conflicts. And if you think about water scarcity, We know that migration will lead to mass migration, often within countries, but also between countries. And so there is a lot of potential for political destabilization, and that also historically sometimes has been trigger of sovereign debt crisis. So there are all kinds of ways how climate change can really undermine public finance and worsen sovereign risk. And there is already empirical evidence that climate change is actually driving up the cost of capital in climate vulnerable countries. So in 2018, we published a report for UNEP, where for the first time we analyzed the nexus between climate vulnerability and sovereign bond yields and sovereign cost of capital. And we were able to show that, kind of looking at a larger sample of advanced and developing countries, that for 25 highly climate vulnerable countries, controlling for all kinds of macroeconomic factors, climate vulnerability was already driving up the average cost of debt by 117 basis points. And that sounds very technical, but it basically means that countries on average had to pay for every $10 of interest rate, an additional dollar because of their climate vulnerability. And we estimated that for 40 members of the Climate Vulnerable Forum, this meant that they had to basically pay an extra $40 billion only in interest payments because of their climate vulnerability. And then if also some external private debt was included, that rose to more than $60 billion. So quite significant amounts. And this is, backward looking. And we of course know that climate change is just going to get worse. And here you have a chart from that report where you can see kind of this positive relationship between a measure of climate vulnerability, the ND gain index, and sovereign bond yields. But, and that was kind of the positive finding in this, we also find a negative relationship between a measure of readiness, resilience, and sovereign bond yields. So which also suggests that investing in resilience actually can help to address this problem. And I don't want to bore you too much with all that, but so it's kind of the self-advertisement section. But we've done a couple of further studies where we've sought to refine the measurements and the methodologies and so on, where we've basically kind of reconfirmed our own findings. But if that maybe increases credibility of what I'm saying, is the IMF also replicated our work, and they basically found the same, and there have been a few others who've replicated or kind of either with the same data or similar data. We've also come to the conclusion that there is this positive relationship between climate vulnerability and cost of sovereign debt. And so here's this from more recent paper published last year. We also have different measures, but a similar positive relationship between climate vulnerability and cost of capital, and negative relationship between bond yields and resilience. And the important point is, of course, that high-risk countries face a much larger risk premium, whereas advanced countries don't have any risk premium. So, I mean, even advanced countries may be exposed, as we could see, for example, in Germany, these floodings, or, we have in the US, all these California, all these wildfires, but, these economies don't have to pay risk premium because in the aggregate, these events are meaningless, but in many developing, emerging countries, the exposures are much greater. So of course we try to do it a bit more fancy as well. So colleagues of mine at SOAS and Cambridge then looked at what are the impacts of climate change on sovereign credit ratings, and they made some projections on how GDP losses related to climate change could lead to massive sovereign ratings downgrades. And interestingly, that also very much affects rich countries, which may not be intuitive, but they of course have much higher ratings. So if you have a very low rating, then the room for downgrade is not that great anymore. So many of the European countries, US, also having large downgrades, but these downgrades will be also hitting developing countries. And what's also very important, as I mentioned before, this doesn't stop at the sovereign, but it also translates to corporate cost of capital. And we did a study where we looked at a quite large sample of more than 15,000 companies in 71 countries. And again, we controlled for all kinds of macroeconomic variables, but also firm-specific variables, and found that there were indeed meaningful impacts of climate vulnerability on corporate cost of capital, and also on access to finance. And that again is very important, because of course we need a healthy corporate sector to advance development. And so the problem is that we basically have in many countries, or that many developing countries are facing a vicious circle where they're already having a high climate vulnerability, which is driving up this climate risk premium, resulting in a higher cost of capital, which is providing less fiscal space for investment in climate adaptation resilience. And then, of course, with climate change getting worse, there is this risk that this circle will just get worse and worse. And so because of that, I've been trying for quite some time to highlight very much the need to break this circle, to try to turn it around, and ideally set off a vicious circle where we see greater investment in resilience, in adaptation, which hopefully would then be recognized by rating agencies and so on, and we've been talking a lot with them, leading to lower risk premia, lower cost of capital, more investment, or more fiscal space for investment in resilience and so on. But for many countries, especially poorer developing countries, small island development states, it's very unlikely that by themselves they will be able to really turn this circle around. And many of them will need international support. And so that's kind of the story, I've been telling before the pandemic broke. But the problem has been worsened because debt sustainability has been further undermined through the pandemic. And as I mentioned before, already prior to the COVID outbreak, the debt situation in many countries in the global south had been worsening. So here you have on the left-hand side a chart showing government debt as a percentage of government revenue, which is more telling than debt as share of GDP. And you can see that since the 2010s, for most developing regions, so except emerging developing Europe, debt as share of government revenue has been rising very significantly. And so the debt situation in many countries is actually where it was when the IIPP initiative, the highly indebted poor country initiative, was started in the mid-90s. And here on the right-hand side, we have a chart, it's very small, so you may not be able to read the country names, but showing external public debt service as share of government revenue in 2020, and this is just for countries where it exceeds 15%, for which data is available. Actually, for many countries, for which data is not available, it's likely to be actually more. But so, you know, you have some extreme cases where more than 50%, like Bhutan, Georgia, you know, goes into external debt service, but you know, quite a number of you know, more than 20% and so on. So this is quite problematic. Here you have some data for Sub-Saharan Africa, which is one of the regions which is struggling the most right now. So you can see external debt service as share of general government revenue having gone up massively since 2010. Interest on external debt as share of exports also has gone up very massively. So a lot of metrics don't look that great. And here you can see the great divergence. So this is the average interest cost of outstanding government debt. So the yellow line is for mature economies. And you can see that basically since the 2000s, you know, the interest costs have gone down dramatically. I mean, there was kind of, during the global financial crisis, there was some spike up, you know, Italy and so on. But, you know, interest rates have been at historical lows in much of the advanced world, whereas developing countries, emerging countries have to pay much higher interest rates. And so this is, of course, very much impeding debt service. You know, if you're Japan and you have 260% debt to GDP ratio, but you have to pay 0 interest rates, you know, that's another story than you know, even if you have only 40% debt to GDP ratio, but your interest rate is 10 or 20%. So far, many developing emerging countries actually weathered the crisis relatively well, if you look at bond markets. So there was this moment in March last year, March 2020, so, where kind of the global financial system was at the brink of collapse, and where interest rates really shot up dramatically. But then the major advanced country central banks flooded the markets with liquidity, and that also helped to bring down sovereign bond yields in much of the developing world. But of course, there have been great differences. But there is now indeed, with interest rates rising in the US and possibly also the Eurozone, a big worry that this will lead to spikes in the developing world. So this is going to be very risky. And if we look at the debt profile right now, so for example, if we look at the Middle East, North Africa, and also Sub-Saharan Africa, the entire outstanding debt is basically high interest rate debt, so between 5 and 8% or above 8%. And with interest rates going up in the US, you don't have to think much where this will be heading. And of course, also other regions partly have to pay high debt. But there's a lot of divergence between countries. And if we look at sovereign ratings, the trend has been very clear, especially in Sub-Saharan Africa. There has been a binge of sovereign rating downgrades, and translated into financing costs. That means rates are going up. Or in fact, many countries will be excluded from capital markets. The World Bank just recently published its World Development Report, where it was also painting a rather bleak picture of the debt situation. So here's a quote from Carmen Reinhardt from the Forward. The average total debt burden of low and middle income countries increased by roughly 9 percentage points in 2020, compared to much lower increases in the decades before. And 51 countries, including 44 emerging economies, experienced a downgrade in their sovereign credit rating. So advanced countries basically were spared the downgrades, but developing countries, many of them got large downgrades. And according to the World Bank analysis, more than half of low-income nations are now seen to be at high risk of debt distress. But there are also a lot of middle-income countries that are in a very precarious situation. And where we are right now is that we have debt possibly rising. I'm just going to take a look at my timer. So interest rates are going to go up, but there's actually a large volume of debt that needs to be paid off. And we're likely going to see a lot of countries already this year, but certainly in the years after, struggling. And, you know, there are some extreme cases like Sri Lanka, where everyone is now basically expecting a default. But the group of countries that are in dire straits is really large. UNDP last year suggested that this was around more than 70 countries that were facing debt crisis. So it's not just kind of a handful of countries. And against this backdrop, we've been thinking about ideas, how can we address the debt crisis, but not only with a view to kind of some short-term solutions, but linking it also with the more structural problems that I discussed about, that I discussed before. You know? So how can we link debt relief with green and inclusive recoveries that will also help countries to build more resilient economies? And of course, there have been efforts by the G20, the World Bank and the IMF to address the debt problem. There was a so-called DSSI, a debt suspension initiative, so where basically low-income countries were granted a moratorium on their debt. But a lot of countries were scared to take part in that because they worried that this would send a negative signal to the markets. And importantly, no one asked the private sector to grant debt relief, because that would have been interpreted by the rating agencies as a default, and no one wanted to default. And markets have been also telling countries how bad it would be for losing market access and so on. And there was also a common framework on debt relief that was put forward for countries that would need debt restructuring. But this framework has not been very successful. I mean, there are a few countries that have gone down that route, but it's not really. I mean, the IMF itself is saying that this is kind of not really working. And just a few days ago, the finance minister of Ghana gave an interview to the Financial Times where he said that kind of the response of the international community was very poor, and that advanced countries should hang their head in shame for kind of not providing support to developing countries and not providing meaningful debt relief. So we have a situation where the debt situation is constraining recoveries, and where risks are rising. And we know from a long history of sovereign defaults that trying to delay needed debt restructuring is just making things much worse, most importantly for the people of the country. So for countries that need debt restructuring, it will be important to really address the problem now. And so I, with colleagues, have been arguing that the G20, which is, basically, which is calling the shots, needs to step up and really provide a framework for countries that need debt restructuring, the opportunity to get one, and combine it with kind of enable a green, inclusive, and resilient recoveries. And so in summer 2020, with some colleagues, Stephanie Griffith-Jones from Columbia University, Kevin Gallagher from Boston University, Shamshad Akhtar, former central bank governor of Pakistan, Moritz Krämer from SOAS and Jörg Haas from the Heinrich Böll Foundation, we developed a proposal for debt relief for green and inclusive recovery, and we've kind of developed this further to flesh out some of the ideas, and I'll try to give you a kind of the key points. Apologies for very text-heavy slides. I'll try to skip some of that. But the first point, or our point of departure, is that basically, as I said before, climate vulnerability and also other sustainability risks are really a key part of this whole debt story. And debt sustainability analysis, as it's conducted right now by the IMF, the World Bank, and so on, is not sufficiently taking these issues into account. So likewise, investment needs in sustainable development goals are not taken into account. And so we argue that debt sustainability analysis need to be based on realistic assumptions. So unlike many of the past debt sustainability analysis, which have had far too optimistic growth outlooks, they also need to take into account investment needs in climate resilience, in Agenda 2030 and so on, and importantly also climate and nature risk. And so we're calling on the IMF and the World Bank, and I've had very good exchanges with them to really take these points into account. And then countries with which in such an extended debt sustainability analysis come out as having non-sustainable debt basically should get debt relief now, because dragging down the road won't really make things better. One key point is that if we talk about debt relief, we need to talk about private sector involvement. So the efforts to date have basically completely excluded the private sector. So there was some debt relief by bilateral governments, but that is not enough. And in fact, what we've been seeing right now is that a lot of the public resources that have gone into developing countries have been used to pay back private creditors. So we've seen a bailout of private creditors, and that's really not how we should use public money. So if a debt sustainability suggests that a country needs debt relief, then we do need the international organizations, most importantly the IMF, to make a very clear, take a very clear stance, and basically say that they won't continue to provide fresh money for countries that basically need debt restructuring. And pressure needs to be put on the private sector to engage in serious discussions about debt restructuring. Now, that is difficult, but we have to seek ways of doing that. And what we've put forward is a carrot and stick approach. On the one hand, we say that building on the experience with the debt restructurings of the 80s and 90s, that there should be a guarantee facility for green and inclusive recovery, which would basically provide a credit enhancement for new debt that would be swapped against old debt held by private creditors, but importantly against a significant haircut. So basically private creditors would have to take a haircut, which of course has to depend on the debt situation in the country, maybe 30%, 40%, 50%. And so that is painful, but in return, they would get new bonds, actually sustainability-linked bonds, which are very much en vogue. And this would come with a partial guarantee on the principal and also on some of the interest payments. So private creditors could swap kind of old bad debt against quite nice green and safe debt. But carrots alone will not do. There would also need to be pressure from the major governments that are basically overseeing the markets where these transactions are governed. And there's actually a rich history. So the US, the UK have used moral suasion regulatory tools to incentivize commercial participation in debt restructuring. So this can be done. There are precedents for that. But we are suggesting that also it would be important for governments to signal that they want to use the debt relief for investing in development and resilience. And so debt relief should not just provide some temporary breathing space, but really empower governments to lay the foundation for sustainable development and enable them to invest in key areas, including, of course, health, education, but also in climate resilient infrastructure and so on. And so what we're not saying is that there should be kind of some IMF conditionality that says, okay, you know, this is the green conditionality that you have to implement, but countries, especially climate vulnerable countries, have all kinds of plans for investing in resilience. So they could build on what they already have, what they want to do, and so put forward their own, what we call green and inclusive recovery strategy. So countries under involvement, ideally of civil society and so on, should put forward their green inclusive recovery strategies. We've put forward some very broad principles. So, you know, kind of no public money used for financing of new fossil fuel supply and so on, taking kind of a positive stance on social equity and so on. Basically have this all guided by the Sustainable Development Goals, but it's kind of very broad framework, so it's not a very constraining framework. So I'm gonna speed up a little bit, but you know, there should be, of course, some public consultation, you know, involvement of civil society, all that. But the important point then would be that basically the haircut that would go then, or part of that would go into a fund for green inclusive recovery that the governments could then use for spending on what they have said they want to spend on. And I won't go much more into detail because I'm really running out of time. Here you have a kind of chart trying to summarize this. So basically, the debtor governments would get debt relief. Private creditors would swap old debt against a significant haircut against new debt, so kind of the green inclusive recovery bonds. A guarantee facility, which we suggest could be hosted by the World Bank, would provide credit enhancement on that. Of course, there would be comparable treatment between private creditors and public creditors, so not only the public creditors, and kind of national parliament, civil society and all that should be involved in designing the green inclusive recovery strategies that countries put forward and use then as kind of the guiding stick for using their enhanced fiscal space. And so this proposal actually has been taken on board by the V20 countries. So the V20 group is a group of 55 finance ministers of the Climate Vulnerable Forum. And ahead of the Glasgow Climate Conference, they issued a statement on debt restructuring options for climate vulnerable nations, where they pretty much along the lines that we suggested, called for meaningful debt relief, and that would enable debtor countries to implement what they call climate prosperity plans. Yeah? So their own plans that they have developed. For me, that was one of the big scandals of the climate, of the COP, that the debt topic was completely not on the agenda. You know, you have 55 finance ministers from climate vulnerable countries demanding to discuss this, and then it's being ignored. But the topic clearly is gaining traction. I mean, not least because the debt situation is clearly becoming ever more worrisome. And as I mentioned, the World Bank just had its latest report where they really rang the alarm bells. And I think it becomes ever more clear that the debt situation needs to be tackled. And I would strongly argue that we need to think the debt crisis in conjunction with the climate crisis and indeed the broader nature crisis. We've actually, I didn't mention that, but we've also done some work where we show that nature risk is actually also a major risk for sovereigns, and this could also trigger major sovereign credit downgrades. This was supposed to be the decade of action. Yeah? So remember the Agenda 2030, you know, so we wanted to achieve the Paris goals, but also the SDGs. And the risk is now that instead of having a decade of action and achieving the Agenda 2030, that many countries in the global south are actually sliding back. I mean, the pandemic has been a terrible blow to development. The SDG, various SDG indices have gone in the wrong direction, and countries that are struggling to stay afloat financially will certainly not be able to invest in SDGs and not be able to invest in climate resilience. So we are now at a point where the major countries have to say whether they want to, the developing world to achieve the SDGs, or whether we should just write them off. And so the good news is that there seems to be this realization that there needs to be debt relief. So here's a comment from Martin Wolf from the FT from a couple of days ago. So I sense that there is now kind of an window of opportunity to do something. And with this, I'm done, and I very much look forward to Katie's comments and the discussion.
Thanks so much, Uri. Thanks. This was great talk, fascinating. I mean, I'm Zooming and chairing this session from Johannesburg in South Africa. And of course, South Africa was one of the countries in the COP26 as part exactly of the more fundamental restructuring related to the energy system and the need for intervening at the very core of one of the countries which is among the most emitter in the global south. I found fascinating this issue around how to understand the structural channels through which basically we move from climate change to not only the cost of the sovereign debt, but also the cost of financing, and of course, how this creates this sort of vicious cycles also in terms of structural change in these economies, which need exactly to create the conditions and to import those technologies that are needed in order to restructure their economies in a more sustainable pathway. And finally, I think this is something that I would be very curious to hear more about in a previous event where Uri was presenting with a number of colleagues, also from including Adam Tooze and others. Of course, one of the key issues that emerge is this issue of the state capacity, right? The capacity in these countries to actually, within that broader framework, I think it's very forward-looking, how to actually use that window of opportunity in a way that actually create a real transformation on the ground, and doesn't derail into a sort of de-risking of the usual suspect in terms of a private investor who have been actually continuing investing in a number of areas which present a number of problems, as you very clearly aligned. So without further ado, we are now having Katie Kedward. Katie is a policy fellow here at IIPP in sustainable finance, so she's greatly positioned to discuss Uli's not only analytical discussion, but also proposal. And before joining IIPP, Katie was at the Royal Bank of Canada, and also she's been working with a number of NGOs, including Share Action and Positive Money, exactly on these issues. So without further ado, Katie, you're welcome, and please, let's share your thoughts, and then we will give Uli eventually 2-3 minutes to reply while I look for questions. Anyone who wants to start putting questions in the chat, in the Q&A, please feel free, or start raising your hands.
Thank you very much, Antonio, and thank you very much, Uli, for what I think we can all agree was a very rich and illuminating presentation of your research, which I think makes a lot of very important contributions to this research area. I think, to my mind, most development narratives relating to green finance very much neglect the particular needs that are faced by low-income and emerging economies. And the one which you've outlined so well is obviously this concept of fiscal space. The Green New Deal campaigns and narratives that we hear in the global north quite often forget that not all countries have fiscal space, and not only that, but also just domestic capabilities to invest for the green transition, which extends to the corporate sector as well, as you said. The other thing is that the green finance movement also has this very clear bias towards climate mitigation. Less than 5% of climate finance mobilised over the past 3 years, for example, has focused on adaptation needs, which is really shocking when you consider that many of the problems that low-income and emerging economies are facing relating to climate change are already here. They're here today. In my comments now, I just kind of wanted to complement your analysis insights with some climate justice dimensions, and also with some international political economy considerations. It's not so much as a critique as I think just some more contextual information, which I think raises some interesting questions on your policy proposals in particular. And as Antonio said, I think what came across really strongly for me in your presentation is this sense of a vicious circle between both climate unsustainability on the one hand and debt unsustainability, whereby greater vulnerability to climate shocks increases the cost of government debt, which then constrains the fiscal space, kind of thereby also undermining resilience in this kind of feedback loop effect, which, as you kind of very clearly articulated, has the potential to be destabilizing in a devastating way. And I think it's also worth emphasizing that this debt overhang dynamic has already been at play for many years within some of these nations from a development perspective. Their bond yields, sovereign bond yields, are already in high, in part reflecting poor outcomes in terms of health, education, underdeveloped infrastructure. And these high and expensive debt burdens are in turn diminishing their capabilities in investing to improve those outcomes. And I think some of the statistics you laid out in your presentation really do hit home in quite a shocking way, that these countries are starting from a position of substantial macroeconomic weakness even before the most serious climate shocks are yet to materialise. So this brings me to the two justice dimensions, which I think are fundamental to contextualise this situation, and one of them you actually already raised. There's this first fact that low-income and emerging nations are facing the lion's share of the worst climate effects and nature effects, let's add, because it's not just climate change we're facing. So facing the lion's share of the worst impacts, despite the fact that they themselves are responsible for a vanishingly small fraction of cumulative historic emissions. And for me, the results of your econometric analysis are particularly eye-opening to interpret from this justice perspective. And in particular, what I mean is the results for the advanced economy bond yields. So even if advanced economies are exposed to climate risks, they will not suffer adverse repricing effects, despite themselves being largely responsible for climate change. And to my mind, this really points out the fact that risk-based approaches to managing climate change, they might strive to be objective, but there are distributional dimensions here that are not easily incorporated into these measures of climate risk. And therefore, the very concept of climate risk ends up being a normative concept. And this concept, I think, is this nuance is quite easily lost in many green finance conversations. And the second dimension of injustice, I think, concerns this structural macroeconomic disadvantages that are faced by many low-income nations. And here I think it's really important that we do not forget history. Not only are many of the most climate vulnerable countries, not only have they been historically subject to systematic and deliberate underdevelopment, in order to enable rapid industrial development of colonial powers, for example, but also developments in more recent history have reinforced these structural disadvantages. So the neoliberal policy reforms pursued under the Washington Consensus, for example, have imposed austerity, the privatization of public services, financial liberalization, and mechanisms like investor-state dispute settlements, for example, all of which together conspire to prevent the types of long-term development strategies which are needed to ensure climate adaptation measures, for example, are successfully implemented. And that speaks to Antonio's point on state capacity, right? To what extent have state capacities been systematically eroded? So yeah, I mentioned these two dynamics because I think these power dimensions are important. Sovereign bond markets respond to estimates of future risk, which in climate terms effectively punishes those countries which are most vulnerable rather than the ones which are most responsible. Meanwhile, the fact that these countries are even so subordinated to the mechanics of global bond markets, the fact that they're even so exposed to these movements is not an accident of history. And in theory, at least, this can and should be addressed through structural policy reforms, which is the subject of the second half of your presentation, of course, and I'll come on to that into a second. But first of all, I just wanted to pose my first question to you. I was reading in detail the policy recommendations in your paper with the WWF and the Asian Development Bank, and they very much emphasize the importance of comprehensively of nations assessing and stress testing and disclosing their sources of macroeconomic vulnerability related to climate change, which I agree, I think is a very important first step in kind of understanding what's at play here. Yeah, my question is, for those countries who are debt vulnerable as well as climate vulnerable, to what extent is there like a moral hazard at play in providing this information to global capital markets? Disclosure of climate vulnerability on its own is obviously not going to resolve the adverse effects of sovereign debt repricing and hot capital outflows, and actually arguably it could exacerbate them. So my real question here is, to what extent do you think there is perhaps for some nations a broader case for the reintroduction of financial repression, including the imposition of capital controls, in order to prevent climate disclosures sparking financial instability from sudden capital outflows, for example? So moving on to the second half of your presentation, which directly takes up the mantle of how to tackle this vicious circle in the context of climate injustice. And I really like the set of ambitious and concrete proposals that you have for reforming the debt restructuring process. And a crucial aspect of the proposal that I really like, and I think what sets it apart from other prominent proposals out there, is this emphasis on the need to get private investors involved in debt restructuring by actually accepting losses on their investments, this carrot and sticks approach, which you mentioned. And, I chuckle because I feel it shouldn't be shocking to state that investors do actually get into these transactions knowing that their value is at risk and that their investment is not guaranteed. So I think you make an important and persuasive case here as for how and why investors also need to step up to be part of the solution. And it's interesting to contrast what I'm going to term a risk-sharing approach that you've taken with the current pervasive narrative that Antonio mentioned, which is about, requiring governments in the global south to de-risk private investments in order to encourage private investors to invest in the green transition there in the first place. And Daniela Gabor has obviously written a lot about this. She's termed this approach the Wall Street consensus. And she uses the example of the World Bank's maximizing finance for development agenda, which in particular has pushed the creation of asset classes such as public-private partnerships and similar. And obviously these instruments have been criticised for requiring governments to take on massive contingent liabilities, such as compensation for the effects of future government regulation, for example, which seems really quite strenuous. But also these instruments are increasingly understood to actually be more costly than direct public investment. So I wonder if you could comment on the feasibility of these sorts of de-risking approaches to mobilising green investment within the context of the looming global South debt crisis. And if you see your proposals as complementary to them or as a direct challenge to this de-risking paradigm. And my third question, and I'll make it my last question, even though I do have many more, relates slightly more to the mechanics of your restructuring proposal, and in particular to the size of the haircut, which you argue should be made on the basis of reforming the debt sustainability analysis, so that it incorporates, on the one hand, estimates of climate vulnerability, but also the fiscal space needed to increase resilience on the other hand. And what I'm wondering is, for the most extreme examples, and you mentioned Sri Lanka, and that's exactly the country I was thinking of, countries which have not only really high debt burdens, but also really high debt servicing costs, and that is the important factor here. These countries, which are also the most climate vulnerable nations in the world, at what point does a debt restructuring exercise reveal that actually debt forgiveness is the most appropriate step forward for nations that would otherwise have fairly little hope of creating sufficient fiscal space for adaptation whilst they're still saddled with these extreme levels of external debt? And I think this question, it's obviously quite provocative, but I think it fits very much into arguments for climate reparations that have been made by scholars such as Keston Perry, among others, as well as the climate justice arguments that have been put forward by the small island nations at COP26, for example. So it'll be interesting to hear your thoughts on this as well. And I know that you have written in the past about debt for climate swaps. So I wonder if you could perhaps comment here on their potential use as part of your reform proposals. And I'll leave it there. I'm very interested to hear your responses and also the questions from the audience. So thank you very much.
Thanks so much, Kelly. Thanks for such a set of sharp remarks. And I don't want to take more time. We have two comments already from the audience. Uli, would you like to take, Katie's question would require a quite long set of remarks. So maybe you can pick up one or two, and then through the discussion, I'm sure some of these issues like the de-risking and so on will come back over and over. So feel free to start from one or 2 points while I invite you, Kao, and Luc Lapointe to join the panel, and then they will raise their point as well. Anyone else who would like to join the discussion, again, feel free to just raise your hand and you will be promoted to the panel. Uli.
Yeah, great. I feared that you would give me 3 minutes to answer to all of Katie's points, which would have been a bit of a challenge. But well, I very much enjoyed your comments, Katie, and a lot of good questions. So apologies for not doing justice to that. But so the first point about the climate vulnerability assessments. So you framed it in terms of disclosure. I would frame it differently. So what we said is that the starting point really has to be that governments fully understand, what the risks and exposures are. Kind of to kind of climate-proof your economy, you first need to really have an understanding what are the physical vulnerabilities, what are the transition risks, and so on. So it's not disclosure in the sense, that kind of TCFD-like disclosure, and then you publish a report that kind of investors can analyze but so the starting point is really, let's have a deep analysis where the different vulnerabilities are, including different branches of government and including also central bank, for example, with a view towards addressing the vulnerabilities. Yeah? And to address the vulnerabilities, countries need to take very proactive policies. This will have to involve kind of a whole government approach, including also industrial policies, all kind of structural policies. Let's say if you are a fossil fuel dependent economy, then you're exposed to massive transition risk. Yeah? So let's say Nigeria, it's not about Nigeria kind of going green, it's about the rest of the world. I mean, kind of if Europe is kind of decarbonizing, I mean, let's assume that for a moment, kind of this will have big impact on fossil fuel exports, and so countries need to proactively address these risks, and in our analysis, kind of we could see how different oil exporters will be hit very differently. So Saudi Arabia, I mean, they have the lowest extraction cost in the world, so they can continue pumping oil until the very end. I mean, they will kind of be hit from 2040 onwards, according to our estimates. But other countries, kind of will get out of the market very quickly. And so they, this will cause massive structural changes, and these need to be proactively addressed. So you need industrial policies to kind of invest in new areas that have greater chance of carrying you through. Or let's say if you're very heavily dependent on agriculture, you need to analyze, what are the physical risks, kind of, can you adapt, can you make your agricultural sectors more robust, kind of, do you have to relocate people, and all, and of course also what are the implications for public finances. So that is kind of our starting point. It's not, okay, let's disclose risk so that private investors can then kind of make, say like, oh, they're even more risky than we thought, and therefore we'll increase interest rates even further. I've been thinking a lot about kind of this, that was also kind of something when we started with this work, when we did this study showing that climate vulnerability is driving up the cost of capital, we were very much aware that, this could be taken against vulnerable countries, but as a matter of fact, they are already being punished. So it is this very perverse situation, as discussed, where countries that haven't contributed to climate change are punished twice, through the physical impacts and also through capital markets. And kind of just trying to gloss over won't help. I'd just like to say a little bit about kind of de-risking and so on. The whole, kind of billions to trillions agenda, kind of blended finance, kind of having private capital flow from rich countries to poor countries, and go into all kinds of sustainable areas. This hasn't really worked. So there has been kind of billions to billions. So the volumes haven't flown, kind of using using public subsidies to incentivize certain types of investment can be useful in certain contexts, but kind of the de-risking agenda, as it's being pushed by BlackRock or so, this is not going to work. And so I've been emphasizing for long that for most developing emerging countries, ultimately they will have to rely very much on domestic resource mobilization. And the reality is that we see huge capital exports from developing countries, even low-income countries, to rich countries. And partly this money is then flowing back, but in the form of very expensive loans or investments. And so strengthening domestic resource mobilization, strengthening domestic capital investment opportunities is very crucial. And relying on large amounts of private capital to go into crucial areas of resilience and so on, especially adaptation finance, that's not going to happen. Certainly, also a lot of these investments have to be public investments, so I think the current development finance agenda is it hasn't worked, and this needs to be rethought. And
if you want, we can come back to some of Katie's points so that we allow some of the audience to. I have two people that raised a couple of interesting points. You can start if you want. You are in the panel already. I'm trying to promote you as well. And please introduce yourself as well.
Thank you, Antonio. No, great presentation. Very to the context of what we're doing. Just briefly, some work we're doing in Latin America in anticipation of the Summit of the Americas. is looking at everything that you mentioned, when it comes to risk, when it comes to defining the capital. We found that, first of all, I mean, there's a big knowledge gap, right? So what's being taught in university here for municipal finance is decades away, like 30 years, 40 years ago, right? I mean, so we're working with university to see how we close this knowledge gap. I also teach at two universities in Colombia. The other thing we've been looking at, discussion with rating agencies, is around hybrid ratings, right? Understanding that sovereign ratings are, at the local level or subnational level, you're stuck with the sovereign ratings. So how do we start looking at the hybrid ratings, looking at the cost of inaction, right? So we understand that not doing something, as we see here, if you look at the capital of Putumayo, was inundated 6 years ago, and they're still reconstructing, right? So even though they knew and people died, 600 people died, and the economy is still not functioning to the 100%, right? You mentioned the vicious cycle, so we understand this as well, that government like Colombia, if they understand that there's a big gap in local, small infrastructure projects in rural areas of Colombia. But again, if they go to market, they're going to get penalized eventually for borrowing too much. But the cost of inaction is much more higher than the cost of borrowing right now. So some of the discussion we're having is around hybrid rating. How do we close this knowledge gap? How do we start creating maybe an alternative marketplace? Discussion with the Emerging Market Investor Alliance and many other development banks from the regions, right? Is how do we change, because we're going to go back to traditional marketplace. I mean, they function in a certain ways, and they expect something in a specific format. So this is what we're looking at, and some discussion around with, as I said, some of the credit agencies, this credit enhancement through transparency, so better procurement. A standard on reporting at the municipal level on project management. Right now, I mean, there's no standard. Everybody reports in a different time, in a different way. So it's hard to find the information, and it's not machine readable as well. So again, to make this possible, we understand it's not the lack of money, right? I mean, there's a lot of capital, a lot of liquidity. So we understand of not doing something will cost more than doing something at this moment. But traditional ratings and traditional marketplace are not built for this at the moment. So we're trying to, just to close, just to get to the summit of the Americas. I mean, really like what you showed, because this is where we're hoping to go as well. Get to some recommendation and maybe an action plan for the Americas, right, on this. So again, a great presentation.
Thanks so much, Luke. Thanks for your remarks. Would you like to raise your point, and then we go back to Uli?
Sure. Thanks, Antonio, and thanks for the great presentation, Uli, and for the great remarks, Katie. Just have a simple question, thinking about, the past history of sovereign debt restructuring and, the proposals that have come before. I'm just wondering, to pick your brain, what do you think has changed in terms of the wider external, international, political environment to make a proposal like yours more likely to succeed as compared to, for instance, the IMF SDRM, the Sovereign Debt Restructuring Mechanism, it was proposed by the IMF itself 20 years ago, or like the principles that were put forward by UNCTAD in 2015 for more responsible sovereign lending and borrowing. Thank you.
Thanks, Louis. But this brings back this international political economy dimension, right? To the extent to which there is now a window for alignment of interest between players. Great questions. Uli, would you like to come back? And then if you want, you can link it up also with some of the points that Katie also mentioned in relation to the broader Wall Street consensus and so on.
Yeah. So, I mean, I think we're not quite there yet. So, we just had last weekend the G20 finance ministers meeting, which was very disappointing, where again, debt wasn't really addressed properly. It is very clear that the current approaches haven't worked. I mean, Kristalina Georgieva has been very explicit about it. She has actually been very positive about the proposals that we made. So she's been trying to drive this discussion at the fund, but there are of course also various member countries that are not particularly keen on that. And I mean, one of the elephants in the room is of course also China. I mean, China is a major creditor, especially to the low-income countries, so much of the discussion around debt has also been, fraught by political rivalries. Kind of Americans blaming the Chinese for being intransparent and for not really being cooperative. But I think that's actually wrong. I mean, kind of the non-transparency aspect, I think that is true. So kind of much of the Chinese owed debt is not very transparent, so that is a big problem. But China has been playing along. I mean, they've signaled their interest in restructuring where they were requested and so on. But you know, kind of the geopolitical rivalries are certainly also part of that greater story, which doesn't make it easier. But I think fundamentally, you know, we will very soon come to the point where the situation will just get so bad, you know, with interest rates rising in the US. I mean, we've seen that time and again. This will worsen the situation, and the big question is just, you know, do we want to give up on the climate goals? Do we want to give up on the SDGs and all that? And we better not. And so I hope that there will be some kind of coming together of the major powers. And one important thing is actually, if we take the private sector, one big difference to previous debt crises, for example, Latin American debt crisis, is that the exposures of private creditors are not that large. So, you know, kind of if during the Latin American debt crisis, you know, kind of there had been a large haircut, you know, the American banking system would have collapsed. And the Americans, of course, didn't want that banking system to collapse. So there was kind of, you know, extend and pretend, which caused the lost decade in Latin America. And only once the American banks were strongly enough capitalized, the Americans were ready for debt restructuring then under the Brady Plan. And the Brady Plan is actually with this kind of partial, kind of these debt swaps, which have a partial credit enhancement. This is actually what we relate to. And there's also, Katie, you asked about the size of the haircuts. So I'm not giving a number. I think the size of the haircut will have to depend on the individual situation of the country. So on you know, how bad is the indebted situation? I mean, you were asking, you know, are there some countries that would need complete debt forgiveness? Well, I mean, some countries clearly need a higher haircut than others, but I wouldn't give, like, you know, there has to be some differentiation. There has to be careful analysis of the debt situation of each country. And then, but one thing I do want to emphasize is that debt relief clearly is not the silver bullet. Yeah, so we are talking, you know, when we talk about the climate crisis, I think debt relief has to be an important part of the mix, because countries that are mired in debt will not be able to do anything properly, right? They won't be able to invest in resilience, in mitigation. They won't be able to invest in health, education, in anything. So debt relief has to be an important part, but that doesn't mean that debt relief alone will be enough. And so certainly we have to talk about, especially for many low-income countries now, we have to talk much more about grants instead of loans. Yeah? So kind of we need to have a much bigger discussion around loss and damage. Loss and damage is also one of these topics that has, you know, is just kind of slowly getting through, but, you know, kind of advanced countries have tried to marginalize these discussions. In fact, when we first presented to some European governments our study on debt, climate vulnerability and cost of capital, some of them were screaming at us because they were really fearing that this would trigger a loss and damage discussion. And so, you know, kind of, and that in a way goes also back to this question about, you know, private finance and, you know, kind of blended finance and all that. Climate vulnerable countries need massive investments in resilience and so on. And if this is basically through private finance and then just drives up debt further, I mean, then it's kind of just, you know, contributing to the problem I just described. You know, So I'm not saying that private finance has no role to play. I mean, especially in kind of more advanced emerging economies, private finance, may play a meaningful role. I mean, certainly not as a kind of silver bullet for all problems, but especially in low-income countries, also lower middle-income countries, there needs to be much more public investment, and therefore we also need much greater grants from advanced countries. We need a greater role for public development banks, also, of course, national development banks, and all that. I mean, I've been almost at the outbreak of the crisis. I've made some suggestions on SDR issuances. I mean, we've now got them, but I mean, this has been also a very sad affair. Kind of advanced countries are only passing small parts of their SDR allocations to developing countries and so on. And one thing which I may just throw in here, I've been also trying to promote. One idea I've been trying to promote is that let's try to reform the SDR system. Kind of right now, SDR issuances. We have general SDR issuances, and every member country of the IMF will get SDRs according to their shares. But we could have SDRs that are being issued, for example, when countries are hit by some climate shock, which is clearly exogenous, so there's no moral hazard. Let's say Barbados is hit by another climate disaster, and then there would be an SDR issuance that would only go there. This would also, be quite fitting from a climate justice perspective, because the currencies in the SDR are actually the currencies of the countries that have contributed the most to global climate change. So the major advanced countries plus China, which now is, of course, the biggest emitter. So I think I just want to put this kind of ideas about debt relief for green inclusive recovery a bit into perspective. I think debt relief will be crucial for many countries, but it's certainly not the only thing. So it's not that I'm kind of on this one track only.
Thanks so much, Uli. Thanks. I think this re-emphasizes the issue around the plurality of instruments that are there, but also the fact that once that space has been created, there is an element of how investment are directed towards the direction that we want to see happening, right? In that form of structural transformation. So your emphasis before on, of course, how the industrial policy element can be used as part of the real, if you want, mobilization of the resources and the instruments that you are advocating. I think it's a very important element. Sorry, you wanted to add something. I'm also looking at if there are other ends, not so far. So please go ahead.
So indeed, kind of this, the idea of our kind of green inclusive recovery plans, kind of linking debt relief with structural changes, that will help countries to be positioned better to address the various challenges, not only climate, but also other nature risk and of course, health, education, and so on. But one thing that both you, Antonio, and Katie mentioned, and I haven't addressed yet, is the issue of capabilities, government capabilities. And that, of course, is a crucial issue. And here I have two answers. One is actually, we should not underestimate the abilities of governments to do things they know they have to do. I mean, no question that they're, developing countries are developing countries partly because, they lack, institutional strength and so on. So we recently had a discussion, kind of an OECD development talk with officials from the Gambia and I think Rwanda, and they have really a lot of plans, a lot of ideas what they want to do. They just need the space to do it, the fiscal space to do it, and so that's one part of the answer. The other part of the answer is I've been actually working for the last 1.5 years on developing a university network on strengthening microfinancial resilience to climate and environmental change, which will be launched very soon and which will support universities in climate vulnerable countries in building a kind of not only educating their own master students, but also then providing professional training to governments to do all kinds of address all kinds of climate and other sustainability risks. So basically trying to climate proof their economies and in a very broad sense. And so capacity building in governments, of course, elsewhere is absolutely crucial. And that's also something that we are trying to contribute to.
Thanks, Uli, thanks. I think there is no other question. We have just 2 minutes left. I would like to give 1 minute to Katie just to say one last comment or remark, 1 minute and 30 seconds, and then we close the event.
Yeah, sure. Thank you very much for your responses to my questions, Uli. I thought that was, you gave some really interesting and insightful answers there. And I particularly like the proposal on the issuance of SDRs in the event of climate shocks. I think that resolves quite a lot of the climate justice dimensions, which I was talking about in my discussion. I just wanted to add one final point, which I didn't have a chance to say in my initial comments due to time constraints, but I just wanted to finish off and say that one of the things I like most about your proposals is that it kind of emphasizes the importance of giving countries back their own agency in determining the pathways for their own green transitions, their own ways of adapting to the threats that they're facing. And I think that's really important. And the looming debt crisis, which you've laid out very clearly, is obviously a huge and really terrifying obstacle to giving back that agency to these countries. So I think, as you say, it's not the full solution, it's not the silver bullet, but it's the really important place to start in order to make sure that the green transition is globally just and inclusive. So thank you.
Thanks, Kathy. Thanks so much. And of course, agency comes with lots of trade-off and problems. Again, in South Africa, despite the COP26 agreement, we still are having significant challenges in restructuring a system that generates electricity, and massive problem in providing sufficient and reliable electricity across the country. And other countries, of course, are now coming to the opportunity to use their resources. I mean, we are working with African Climate Foundation in Tanzania, for example, Mozambique, where gas is there, and now they think, the government thinks it's our chance now to use these resources, right? So agency comes with major trade-off in this complex set of issues. So thanks, Uli, for helping us in navigating all these very interesting and very focal issues in today's discussion. I think we managed to make several links with several research agenda and ideas. Thanks, Katie, for excellent remarks, and thanks everyone who joined tonight our meeting. In a couple of weeks, we're going to have another event, and we are particularly pleased. We're going to be launching a new book on new countries, talking about states and the active role of the state in managing big challenges. Thanks so much, everyone. Thanks again, Uli.